If you're thinking about coming to the summit, it's a really great opportunity. I can't emphasize how valuable it is just to hear about all the new innovations, but also the networking opportunities.
It's a great place to network, and they've done a fabulous job with bringing in certain speakers from around the mortgage industry to kind of provide their insight.
If anyone is on the fence of whether they should attend this event next year, there's just jump over the fence. There's so much content that you are going to get out of this.
I definitely highly recommend coming. You get a lot of just engagement with the OB team themselves, but also get the additional knowledge and information about what they're working on.
If you're setting your schedule for next year, for deciding which conferences you're going to be sending the people to, you're going to be attending yourself. I mean, this is one that you have to show up to.
So our innovation is going to focus on the most important aspects of your job.
There's something so magical about being able to share our profitability expertise that only Optimal Blue can provide.
We're not just delivering software, we're delivering solutions that empower you to make smarter decisions, operate with more efficiency, and stay ahead of the curve.
Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jeff McCarty, Vice President of Hedging and Trading Product at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. So we've got a great episode today. Obviously, a lot to talk about coming out of the Fed announcement to cut rates last week, and then the corresponding rise in interest rates. So as we kind of foretold in some of our previous podcasts, we thought that might happen. We've got the 10-year at 4.14 this morning, the OBMMI at 6.268 as of end of day Friday. So again, rates jumped a little bit over the past few days after the Fed announcement. So we're going to dig into that, talk a little bit about what might motivate that and some of the motivations of the Fed and some other industry players going forward. So excited to talk with Alex, James, and Kevin today. So let's jump right into it. All right. Welcome, Alex, Kevin, and James. Thanks as always for being here. So let's get right into it. Alex, maybe you can just kick us off with, what actually happened with the Fed announcement last week and any key initial takeaways there.
Yeah, absolutely. Pleasure to be here. And last week, the highlight of the week was really the Fed announcement on Wednesday. It came in where the market was expecting it to at a 25 basis point cut. I think the biggest takeaway was that Stephen Myron's was the sole voter for a 50 basis point cut when the rest of the board aligned, kind of unified, maybe on some political grounds. It's kind of wishy-washy on that. I think they truly thought 25 basis point was the risk-averse cut to make, address some of the labor concerns in the market without, really expending a lot of that ammunition that they would have for a larger downturn.
And we just saw some comments come out just before we started recording from Myron arguing for even more aggressive rate cuts. I think he argued for essentially a 2% cut in rates.
Yeah, bringing that down, that's nowhere near on where the dot plot was that we got. I think he needs to do a lot of convincing on the board right now with who he's talking to.
But his argument is just kind of the classical argument is that people are paying too much attention to inflation and not enough attention to the risks of the employment situation.
Yeah, they seem to be comfortable with the 3% or thereabouts, maybe a little under right now, inflation target. I think that's perfectly politically sustainable, especially after the last few years. 3% feels pretty tame. And yeah, they seem to be fully pushing on the labor front as the main concern on the economy, getting what they view to be back to full employment. We saw some drama around H-1B visas this weekend. Trump saying upwards of $100,000 per visa, which will really throw a kink in the talent pipeline for a lot of tech companies in particular.
Yeah, that was an interesting announcement. The details, it seems like the details are a little bit up in the air, and obviously there'll be some lawsuits as that gets figured out in the coming months. But that is definitely one to keep an eye on in the coming months. Let's dig into kind of what happened after the Fed announcement a little further. As we've been preaching, the Fed funds rate target is not indicative of other rates in the market, right? So the 10-year and obviously mortgage rates as measured by the OBMMI. And we kind of had this perfect example over the past few days, right? So Fed announces a cut in rates, and we've seen the 10-year and the OBMMI push up about 0.1% in rates over the past 3 or 4 days.
Yeah, overall, it seems like a very, very similar story so far to last year, where we had rates dropping, OBMMI dropping in anticipation of a September Fed cut, and then shortly thereafter, starting to see the 10-year rise. Although it's been fairly muted so far. I think still awaiting some of the big economic data this week. We have core PCE, I know, later this week, and we've also got revised Q2 GDP numbers. We have the September non-farm payroll coming up in the next couple of weeks. So maybe some market participants still waiting to see what the next batch of data looks like post Fed rate cut.
But no, with what you're saying there, Kevin, it brings us back to what we've been talking about, how one, the long end of the curve does not directly follow the short end of the curve. And it also shows that there's potentially some shakiness out there from bond investors, and that they may not 100% agree with the direction the Fed is taking things.
Kevin, I think that kind of tees up to something you wanted to talk about, that the short-term interest rate is really controlled by the Fed. That's what everyone is watching. That's what we're talking about every time the Fed goes to cut. But the long-term interest rate is a lot more controlled by bond investors and how they feel about the government, how they feel about debt, how it's going to get paid. And that 10-year in the middle is really the spread between the two. It's what's going on in that middle term. And we've had some kind of interesting thoughts thrown around from the administration and other economists just about what's going on with the 30-year and how the Fed could maybe act differently to try and help those middle and long-term interest rates.
Yeah, I know some of us were talking here recently. There is about a third of all outstanding U.S. debt needs to be refinanced in the next, was it 12 months or so? So I think there is, some political pressure involved in trying to refinance that debt at more favorable terms, which ultimately, has an impact in the bottom line of the U.S. Treasury and ultimately, benefits the U.S. economy. But in order to do that, that's a little tricky, because normally those, that refinance rate is going to be dictated by, market conditions. But there's obviously a big political incentive to try and get that a bit, more in favorable terms, which, seeing some inklings of that from the administration. I know, Alex, this is something you've been following pretty closely as well.
Definitely. I think it's been explicitly stated on just a handful of occasions now, but they're definitely interested in refinancing that debt at the lowest possible rate that they can. Our debt to GDP ratio is, as we talked about, I think a couple months ago now. Jim was big on it a few months ago, but we're second only to a couple of fully developed economies such as Japan. And while we do have the kind of global dollar system to prop up demand for dollars, there are emerging concerns around, at what point is the U.S. debt unsustainable? It's a conversation we've been having for decades at this point, ever since we started really taking on debt in the early 2000s after balancing the budget in the 90s. We saw it during the global financial crisis quite a bit, a lot of austerity measures, 2010, the Tea Party movement was fully, around, keeping government spending in check. That's not what we've seen, from either side of the aisle over the past 15, 20 years now. So it's just really interesting. And I think maybe there are some alarm bells that they don't want to explicitly, put out there in the news, but I do think that there is a point where, we're well over 100% debt to GDP ratio at this point. And then
I think it was around 10 years ago or so. I talked about this in a LinkedIn post a while back, but one of the most stable holders of U.S. government bonds are central banks in other countries who are using U.S. treasuries to balance the valuation of their own currencies against the U.S. dollar. And for a long time, the availability of US debt sort of kept pace with the demand from central banks around the world. And in about 2015 or so, that stopped. And, the pace at which, the demand from central banks decelerated and the rate of US debt accelerated. And so that's created this, additional sort of glut of U.S. debt that, is going to other institutions, which are, in some cases, more likely to sell or, buy based on market conditions, other than, that more stable, component of demand to prop up currency. So definitely going to be an interesting story to watch, over the coming months as, we see a lot of this playing out both in, in Washington and in the markets.
Just to tag a couple of numbers that Alex and Kevin, you guys were kind of stepping on. I saw that the average rate of the debt right now is about 2.7%. And so 1/3 of it is going to need to be refinanced this year. We have a couple of months left. It's going to be refinanced at roughly 4%. That's going to add about $300 billion to the servicing. So it's more than I'd care to throw around. Who owns the debt is something I always kind of look at. It is roughly 70% of it is owned by the United States, our own government, citizens, private equity, investors. It's roughly 25% is owned by the rest of the world. And kind of the big players that you would think, it's Japan, it's China, it's the UK, combined, they own less than 10%. So I'm always a little surprised by that. I think of who owns our debt, I really think of probably Japan and China own half of it. It's not even remotely close to that. So it's always, you still got to pay it. But it's comforting to know at least it's us.
Yeah, every now and then you hear concerns around the debt bomb or what happens if there's a mass liquidation of foreign holders. But I think going back to what we were talking about, the main concern here is that servicing. And as with any lending, lenders are concerned about, am I going to get my money back, and at what rate of inflation? I think inflation is definitely a concern for them. And then, distantly speaking, decades down the line, they're asking themselves, am I going to get paid in full in 30, 40 years? I think the United States absolutely will be here in 30, 40 years. But this is when you're investing in other countries, throughout the world, that is a concern. And it's still something that factors into all their models.
Yeah. And I guess so, like to bring this back to kind of where we started, we had the Fed cut last week. We have this sort of looming debt refinance over the next year or so, and the terms ultimately at which that debt is going to be refinanced is sort of going to be determined, in some cases, by how fast and how far the Fed is cutting, and then how markets are responding to that. Alex, you're sort of teeing this up. Is now that we're post-cut, we're in a post-cut world. The big question is how fast and how far are they going to go, and it's really kind of all over the place. When you look at the dot plot, which you referenced, Alex, which shows where the different members of the Federal Reserve Board expect interest rates to be, going out in time, and it's anonymous, so we can't see who's plotting, which dots, except there's one that was very far below the other ones, and we can all kind of assume that that's Stephen Myron, who's out there arguing for the biggest cuts of all. We are sort of entering this new environment. We have a new term as well, risk management cut. Not really sure what to make of that. Is that hawkish or dovish? But I guess time will tell as the next round of data unfolds. But we really are entering this new era now that we had this certainty around near market certainty around the Fed rate cut. We're getting into a much more sort of ambiguous environment, and potentially that's why we're seeing rates pull back a little bit because of that level of uncertainty, post rate cut. But not sure what you guys are thinking about, as we're going forward in time, and what the next chapter may hold.
Yeah, I mean, I was kind of looking around at what might they be looking at is to establish this 2%, as their ideal target rate, and actually that's right where we were in 2019 pre-COVID. So there's potentially a historical basis there. We didn't spend long there is the thing. We had just, kind of rocketed up off the zero lower bound after the close to a decade of zero interest rates after the global financial crisis. And they settled around 2.5 in 2019. So, I think that's maybe their historical precedent. They can say, okay, there's been a half decade of a historical anomaly. There was a massive pandemic followed by supply chain issues, and then a bout of inflation. How do we get back to what was normal. It is a half a decade ago now, but that is the last time things were normal, per se.
To tag in on that, so if you look at going from like 1960 until the mid 2000s, the average rate, it was actually for the Fed, it was around 5% is the average. And so right now we're sitting 4 and heading below, right? It's actually, we are already below the average, the long-term average, by a decent amount. If we want to get to that 2% and call that the average, that's definitely an outlier within US history, that 2%. And something to consider within that 2% is every time we had a number like that, we also had quantitative easing happening. So the Fed was going out and buying bonds and helping to force those rates down. And that's something that Bassett and the administration have said they're actually very wary of doing. But if you're not going to step in and become the buyer and start purchasing mortgage bonds, starting to purchase treasuries, it seems very difficult to get to that 2% as the average rate. It seems difficult to do that without very much driving inflation.
Yeah, I want to explicitly just call out one thing, which is kind of the third mandate of the Fed, which calls for moderate long-term interest rates. And James, you talked about average. So, moderate, average, what is moderate or what does average mean? There's a lot of leeway for interpretation there about what that means, depending on what your goals are. And certainly, what are the Fed's goals relative to the administration's goals? As I thought that conversation on refinancing all this debt that we have outstanding that we have out there really sets the stage really well about what are people's incentives right now to define what moderate means.
Yeah, and to pick up on that, Jeff. So Stephen Myron came out recently talking about that third mandate, which is sort of, it is part of the Federal Reserve statute, but we typically think about the Fed's mandate in terms of its dual mandate of inflation and unemployment, but that is part of what they're chartered to do. So when we say moderate long-term interest rates, yeah, there's a lot of wiggle room around there, and there's a lot of in my opinion fairly legitimate criticism around the Fed and the extent of their role, and we've had this whole period pre-pandemic with QE and buying MBS, which obviously is was beneficial for our industry for a long time, but now we're sort of feeling the drawdown of that, and whether it makes sense for the Fed to get into these these other areas. But what's interesting about it to me, and I know I mentioned to you guys, I recently finished a book called The Price of Time, which came out a couple years ago, and that's by Edward Chancellor. I found it pretty interesting. It's a little dry. We'll talk about the history of interest rates, but kind of fast forward to a lot of the 20th century and getting into the 21st century. A lot of the criticism is around the risks of keeping interest rates too low and what that does to the economy and how that sort of distorts investment, causes asset bubbles. A lot of things that we're sort of familiar with if we're watching the markets closely. And one of the arguments that it made also was in the run up, in the post.com boom bust, there was kind of a lot of pressure on the Federal Reserve to keep interest rates low, and that pushed a lot of investment out into higher yield, more risky investments, and was one component of setting the stage for ultimately the Great Recession. So, I think it's important to put that out there because, a lot of us, especially we're in the mortgage industry, we want rates to be lower. We want things to, kind of get back to what they were in the 2010s and more housing turnover and all those things. But there's sort of that other side to be aware of. If we're trying to engineer interest rates to be lower than they ought to be, there are some downside risks to that as well. And that really ties up into the whole question of what's the role of the Federal Reserve? How much should they be really pursuing these goals, aggressively or, moderately, and what should the stance be? And we're really seeing a lot of that playing out right now, just with the variation of voices that we have in the Fed now, especially with Myron, who's, a bit of maybe, I don't know if this is, he would appreciate this term or not, but a bit of an iconoclast, at least in my opinion. Very smart guy. He had written the Guide to Restructuring the Global Financial System, which set the stage for a lot of what the Trump administration has been doing this year from like a global trade perspective. But we are sort of in this time period where there's a lot of these very varied forces at play, and we're really having arguments about very fundamental things, not really like nitpicking here and there, but much more fundamental things about who should the Fed be, how should we think about setting interest rates, and ultimately who gets to decide that.
Well said.
Yeah, it's going to be interesting to watch. As always, there's a lot of moving parts here. So we've talked a lot about the debt. Let's talk about something kind of upcoming in the very near future and how that might affect things. We've got the looming government shutdown coming up at the end of the month. So what are we watching for over the next 10 days here, really?
The argument right now is on the Hill. The Democrats are trying to fight for a little bit. There's a tax credit on health and human services, as well as Medicare, that's going to be expiring. So they're trying to push to keep that, as well as they want an assurance that the current lineup of where money is allocated will stay as it is. So it won't be pushed around any. That is what the hill that they're going to try and die on. Ironically, if the government shuts, then the Treasury can only fund money to the current allocations. So it would actually work in their favor. On the flip of that is it would give the administration a lot of power to decide who is, a important individual who can and can't be furloughed. So they could kind of pull a little Doge move, which is probably the coin flip that the House and the Senate are sitting on right now. But come September 30th, we will hit a ceiling, and they will need to decide how to continue funding the government. And if that doesn't go through, it's always kind of a disaster for people all over America.
Yeah, it's never pretty. There's going to be a lot of finger pointing, obviously, over the next couple of weeks. I think we've kind of built out the playbook and been through this, several times over the years before in the mortgage industry in particular, right? You're going to have a slowdown of things like, IRS tax transcripts, various parts of the underwriting process, government loans will sometimes get slowed down. So kind of dust off those playbooks as you're thinking about how it's going to affect your day-to-day in the mortgage industry. In terms of rate volatility, it's probably not going to affect rates too much, probably more operational volatility as we go through that in the next several days, but something to keep an eye on. What else we got hanging out there over the next several days in terms of economic data, Alex?
I'd say the big thing for this week, there's a lot of speakers from the Fed this week, just throughout the week, sprinkled throughout. They're out of their blackout period from this Fed meeting. As we've touched on quite a bit, Myron was talking during, while we've really been recording here. He started speaking just before we began recording. So I would absolutely say that it's worth checking out his comments. And then the big data release for the week is going to be PCE. Again, that's that Fed's preferred inflation metric, and that comes out on Friday.
Yeah, we had the St. Louis Fed president speak earlier this morning, talked about last week's cut being precautionary, which kind of goes along with that risk management take as well, right? And called policy between modestly restrictive and neutral. Thought it was just a good way to frame it of where we're at, right? So that, on the average, going to see a few more rate cuts to get to a neutral rate policy. But again, probably, see how many of the Fed governors start to look more towards a more aggressive rate cut strategy.
Yeah, and one other metric just to throw out there, which I think is important to track, but may not be on a lot of folks' radars, is the Atlanta Fed's business inflation expectations. And those are published on a monthly basis. So you kind of have the two components of inflation, which are what is inflation actually, and then the business inflation expectations are forward-looking based on a survey of business leaders around what they expect inflation to be over the next 12 months. And the reason why I point these out is because I think it's a fairly interesting to watch. We're all sort of aware that tariffs are sort of, starting to make their way into inflation numbers a little bit. There's a big question of, to what extent we'll see that happen. And then does that end up creating long-term, inflation expectation pressure? And so far, inflation expectations have held pretty steady over the last several months at 2.3%. So even though we are seeing a bit of, uptick in inflation data, I think the headline coming out of that is that doesn't seem to be turning the dial up in terms of what those expectations should be, making that more of a long-term issue. So, we're still in this period where it's really more of a short-term concern. Maybe businesses they're really their one-time price increases, assuming that they're stable sort of from here on out. Businesses are starting to slowly eke some of that those price increases back to consumers. But the thinking so far is that tap should turn off at some point. Whether that holds steady or not, yet to be seen. But that business inflation expectations metric is something that, in my opinion, is pretty important to keep an eye on as we round into Q4.
One last comment on inflation is that we just all seem to be getting a little bit more comfortable with high 2% inflation, and we'll just round that down and call that 2%. I guess at this point, right? There was a good question to Powell from a reporter pointing out that he keeps talking about, we'll get it down to 2% in a couple of years. We'll get it down to 2% in a couple of years, but never actually do. So, asking if that 2% target is actually achievable. Anyways, I think plenty of Fed governors still keep pounding that, but we'll see how much the other side, how strong that voice grows. And of course, with watch the employment situation closely. Good. All right. Anything else?
Just looking for a two handle.
Yeah. Two handles good enough, I guess. All right. Thank you, Kevin, Alex, and James, as always, for your insights.
Thanks, Jeff.
Awesome. Great to chat, guys.
That's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analyses and insights to help you stay ahead. Check out our full videos on YouTube. You can also find each episode on all major podcast platforms. Thanks for tuning in to Optimal Insights.